This program proudly brought to you by IPO Wealth for the sophisticated investor.
Hello and welcome to Money Talks, where we have a very simple goal, and that is to make you richer. Tonight we explore what financial advice will look like after the Royal Commission. And Julia Lee looks at gold stocks, and later we see how SMSFs are investing right now, and we look at some strategies that sophisticated investors are relying on with IPO Wealth's James Mawhinney. Okay, the Royal Commission has unearthed a lot of questions about our financial system. So how will financial advisors be affected? To answer this question, we have legendary financial planner Noel Whittaker, who is now executive in residence and adjunct professor at the QUT Business School, and the nation's assistant treasurer, Stuart Robert, joining us on the program. Thanks for joining us, gentlemen.
Peter, great to see you.
Okay, let's kick off with you, Stuart. Thanks for coming on the program. You've heard a lot from the Royal Commission. Clearly, you have a responsibility to have an impact on financial advice. What are your initial thoughts of what you want to do?
If you look at what Hayne has said in the interim report, and of course the final report comes out on 1 February, he's pointed to cultural problems of greed over the consumer's best interests, problems of putting advisors' best interests above a consumer's best interests. So I think one of the overarching issues that we'll have to deal with, we as a country, is how do we get trust back into financial advising so Australians feel very confident going and getting the advice they need and following that advice. That concept of trust will be key.
Can you think of a standout change that you would like to make, even before you even see Hayne's recommendations? We've got a rough idea what he's going to say, but you must have in your mind at least one big reform that you'd like to bring to the table.
Well, if you look at accountants, every accountant is either a CPA, part of the IPA, the FTAA, or part of the Institute of Chartered Accountants. But that's not the case for financial advisors. Some are part of the AFA, some are part of the FPA, there are other associations, but there's no requirement for an advisor to be a member of a professional body, a professional board, and accredited and educated in that respect. I think that one thing would go a long way to professionalising the industry. Okay,
let's talk to Noel Whittaker. Noel's been a financial planner for a long time, written some of the most famous money books that this country's ever seen. Noel, you've heard a lot from the Royal Commission. You've obviously had your views on what financial planning should be like and what should do. What would you like to see happen to financial planning?
Well, Peter, I'd like to point out I sold my financial planning business 12 years ago, so now I'm an independent commentator. And I think I certainly agree about having professional bodies, but what I don't like is this push to make everyone get a degree whether they need it or not. They're trying to wipe out the CFP, and I think the CFP is a very good qualification. And I think one of the offshoots could be a lot of very good people will be forced out of the industry. And the industry at the moment needs good people.
Well, but Noel, do you think that there is a better way to end up with a good collection of financial planners other than having a degree? And if so, what is that alternative qualification?
Well, Peter, you'd never ask your local doctor aged 55 to go back and restudy medicine. And you wouldn't ask your lawyer to do that. What I'm saying is there's some very competent people, very well thought of, with a CFP now, and they shouldn't be forced to go back to university because it doesn't serve any purpose. It'll just force good people out of the industry.
So, Stuart, what do you think about Noel's view on that?
Well, it's always difficult to disagree with a financial wizard of Oz, and I was just saying, Noel, to Peter, one of my first investment books I ever got when I was 12 years old was Making Money Made Simple. However, if you went to
now, that's great.
If you went to your doctor or you went to your accountant, you would know by virtue of their qualification they had a degree to start with. Because you can't be a doctor without it, and you can't be an accountant without it. So there's this groundwork of understanding of what you've got. So the government has now moved in line with what the FPA, the financial planning body, has put in place to say you've got to have a base level of qualification. But Noel is right, there are very experienced planners out there we don't want to disadvantage. So I think what you'll find is those with professional qualifications and those with certifications will probably get half of the new standard of 8 subjects will get recognition of prior learning, and they'll then just need to do a small bridging course in recognition of their skills, knowledge and experience.
Yeah, no, because you've been in the game a long time, there was a time when I can recall changes were introduced and a lot of insurance brokers all of a sudden became financial planners. Did that particular move worry you at the time? Because you had a lot more sophistication and training when that particular development happened.
Oh yeah, Peter, look, there is no doubt there's some bad history, but I think the bad history is a long time ago. And I think the trouble with the Royal Commission is they've picked on the bad apples. I mean, most financial advisors are quite good, but what the Commission did was just pick out the bad apples, and that's given the industry a bad name. You know, people need good advice more than ever, and that's a fact.
Yeah, but Noel, would you support the idea, say for example, if the government introduced some kind of screening system where, you know, ordinary performing financial planners actually were brought to book, just like lawyers, when lawyers misbehave, they've got to go to their various legal bodies and sort of face the music, if you like. Do you think this industry, our industry, requires that?
Well, at the moment they're supposed to have it, but I mean, looking at the Hayne Commission, it was obvious that when complaints went to the industry bodies, they were more concerned about keeping the reputation of the body and not fixing up the customer.
So, Stuart, do you think that's probably what we have to think about, is having an objective assessment group? So if a consumer really feels as though they've been hard done by a financial planner, because I know it can go to ASIC, but clearly it hasn't worked given what we saw in the Hayne Royal Commission.
Well, 12 days ago, Peter, the Australian Financial Complaints Authority commenced, which was an amalgamation of ostensibly 3 ombudsman bodies. So the FOS and, of course, the body that dealt with superannuation have all merged together. That's now operating. So anyone with any complaint in the financial planning industry can go to AFCA, Australian Financial Complaints Authority. Just Google AFCA. It will come up. It has got enormous resources. There is no cap on the awards that it can make. It can hear cases well in excess of $1 million. So that has been put in place now.
Will lawyers be involved, or will it be just, you know, the complainant, the financial institution involved, and the conciliator? It
is designed for the simplest possible approach. So there's a range of ombudsmen in there that can actually just receive an information set and then make decisions. So there'll be times when there'll be no hearing at all. It's not like the Administrative Appeals Tribunal where that sort of recourse is available. So if people have got concerns right now or complaints, if they believe they're being hard done by, AFCA, Australian Financial Complaints Authority, it's open right now.
I think you're the first politician, apart from the Prime Minister when he was Treasurer, who told me about AFCA. You're not really marketing that as well as you should, I reckon. What's your honest view?
Well, my honest view is I'd love to talk about these things every day because they're really important.
They are important.
Especially now that it's a one-stop complaint shop.
Yeah.
And consumers, citizens can just go to one place, just one.
So is the financial... Is the Ombudsman gone? Is the Ombudsman gone now, has he?
No, the Ombudsmans have all folded together and there's now more of them. So there are more people actually capable and able to make a decision.
So all the Ombudsmen now, they're in one bundle, is that right?
They're in one bundle with one process and one place to go to.
Yeah.
Good.
Now, Noel, one of the areas that have been brought up in the paper recently is around insurance and commissions to advisors. In the past, have you worried about the magnitude of particularly the upfront commission and how that could influence financial planners in encouraging their clients to change policies so they get the upfront commission?
Yes, but I think those days are behind us too. I mean, I think the upfront commission are mainly in the insurance products. They certainly aren't in the managed funds products.
No. No, but on the insurance one, has that been something that's bothered you in the past?
Well, yes. I mean, I've seen it happen. Absolutely, yes.
Okay.
Yes.
And so, Stuart, do you think that's an area that you'll be looking at pretty seriously?
I think it's an area the Hayne Commission has looked at. and we're preparing, of course, for Hayne to make a raft of recommendations on the 1st of February. And I think in areas of commissions and conflicted remuneration and issues of trail, that he may well go there.
Because the interesting thing is, and being a financial planner myself, I know that you can do a hell of a lot of work for a client and they don't get a policy, and how do you charge them? So it becomes a very difficult thing, and I think that's part of the reason why the industry came up with these unbelievable kinds of remuneration for financial planners when it deals with insurance.
Well, under the FOFA reforms that came in 5-6 years ago, of course, commissions or trail in insurance was dropping to 80% and then 60% the following year, and that kicks in 2020. Now, that was a bipartisan government report, 11 recommendations. I was one of the opposition MPs at that stage that did that bipartisan report. So I think that's gone well, and we're still waiting to see that roll into 2020. But I think the Hayne Commission may well make some remarks in that space. Okay,
so when do you think you have your policy response before the election?
Well, I think Christmas has been cancelled for the Treasury Ministers, Josh and I, and certainly the Prime Minister. The Productivity Commission comes down on the 20th of December on superannuation. The Hayne Royal Commission on the 1st of February. A fair bit of work has got to go in before then. And of course, our response would need to be known soon after that.
Okay, Minister, thanks for joining us.
Great, Peter, thanks.
Thank you very much, Noel, for joining us on the program.
Thanks, Peter.
So coming up, we have Bell Direct's Julia Lee, and she's going to go for gold with her sector spotlight on the stocks that are glistening at this point in time. Welcome back to Money Talk. Unlike steel, gold can't be used for cars or to build office towers or many other practical purposes. Yet for centuries we've been obsessed with this largely useless metal. With talk that growth is rolling over, is now the ideal time to talk about gold. Julia Lee, equity strategist at Bell Direct, is here to take us through investing in gold. So why are you talking about gold?
Well, I think, you know, with growth rolling over, gold really comes into its own when there's a bit of volatility. So I think, Pete, there's 3 key reasons why people would consider looking at gold, either as a safe haven asset because they think volatility is increasing, or as an investment. The investment side's a bit hard because we are seeing rising interest rates over in the US, so that's a bit of a barrier to holding gold. But when we saw the market pulling back in October, as we did, one of the best performing areas has been gold.
And inflation is starting to kick in the US. What happens to gold prices when inflation goes?
Well, inflation is also seen as, gold is also seen as an inflation hedge. But I suppose more importantly from a portfolio perspective, gold moves differently to equities as well as bonds. And when it comes to diversification, it's not so much about making the most money you can, it's about protecting your capital.
Okay, how much gold do you hold in your portfolio?
About 2% at the moment.
But it is interesting. Some people just hold it, and even if it takes 2 or 3 years to make their money, when the stock market crashes, gold goes up.
So I think there's 2 ways of looking at it. One is through a portfolio approach and through diversification, and because it's not an asset that moves like stocks or bonds. And the other is through event risk or increasing volatility. So if you are scared about volatility increasing and the market going down a bit more, then gold can be a good option at the moment.
Tell us the stocks you like then.
In terms of gold, I like Australian exposed gold miners, and that's because gold prices are in US dollars. So as the Aussie dollar moves down, the cost of production moves down. So one of the key ones there is Saracen, which is looking very good. The all-in sustaining cost, so the cost of production is extremely low, below 1,000 Australian, and look, an increasing growth profile. At some stage, I'll be targeting about 350,000 ounces, but there's a potential for 400,000 ounces if they use technology and some of the crushing technology out there. So Saracen's one option.
Is it number one?
Number one.
Okay.
And when I look for gold, I look for things like the cost of production as well as the growth profile, because there's only so much gold as a resource, and once you've dug it out of the ground, that's about it. You have to renew your resource and buy more assets.
Okay, number 2?
Well, number 2 is just bought a new asset, which is a Pogo mine. So this is Northern Star, and this absolutely transforms the company. This is a tier 1 asset in Alaska, and it means that the production profile and the growth profile of Northern Star will increase. And I like to see those catalysts in terms of gold companies.
It's been a good performer, Northern Star, hasn't it?
It has been a phenomenal performer. And look, I think it's been smart picking up these assets while gold prices have been relatively depressed. compress, and if we do see that volatility increase, then we could see some more speculators as well as investment managers moving into gold. The other thing is the Indian wedding season. Yeah. It runs from October to December and mid-January to March. Yep. And during that season, it can count for around about 20% of the demand of gold.
Okay, quickly, the third one.
There is no third one.
There is no third one? Well, then you've ended nicely.
But if you are scared of a crash, don't buy gold stocks, buy physical gold, because when the market crashes, even gold stocks.
That's right. Friends of mine have got the gold price right and got the wrong company, and that can bring you undone as well. Julia, thanks for joining us. Thanks. That's Julia Lee from Bell Direct, and coming up next, we'll be talking to a gentleman that is looking at how high net worth investors should be looking at the markets right now.
Coming up on Money Talks, jumping markets are making for nervous investors. We'll speak with IPO Wealth CEO James Mawhinney about strategies that can take some of the stress out of investing next.
This program brought to you by IPO Wealth.
Tonight we're looking at some of the trends that uber sophisticated investors are looking at as the markets go through a bout of volatility. Here's Anjali Rao with the Managing Director of IPO Wealth, James Mawhinney.
James, great to have you with us today on the show. Now, when we look at macro investment trends, investors are looking at those that are income producing increasingly. So that's things like property, dividends, bonds, and fixed income funds. What's the thinking behind that?
I think it's important to note that there's certainly been quite an increase in the number of income producing investment products that are available. If you look at some of the more traditional products, things like term deposits and the property market have been around since the year dot. And the reason that investors have tended towards those is because they provide them with a consistent income stream. Often these income streams can support lifestyle requirements, even just basic bill paying and things like that. But what's happened is in more recent years there's become a lot more income producing products out there. There's funds, dividend funds, and a range of different products that now pay investors regular consistent income streams, which can go a long way to supporting their cash flow requirements.
And we're now seeing a shift away from banks and a move towards non-bank lenders. What sort of opportunities is that transition creating?
So I think there's two aspects to the opportunities that have really appeared as a result of the shift of trust away from the banks, particularly with the Banking Royal Commission of late. On the one hand, it's creating a much bigger market for organisations that provide competing products to banks. So there's a lot of non-bank lenders that are popping up. There's also a lot of organisations in the fintech space providing aspects of what the banks do. One of the biggest opportunities is definitely the non-bank lending, because if you look at whether it's an individual or a business applying for credit, a lot of these organisations and individuals, if they go to the bank's only prepared to lend, say, up to a certain amount. But a lot of these new lenders that have certainly popped up in recent years, they're a little bit more lean, a bit more meaner, keener to, in some instances, acquire the business because they don't have the same operational overheads that, say, the likes of the Big Four have. And it means that as a result of that, they're able to provide a level of service or a rate of return, or at least a cost of that capital, that's actually a lot more attractive to the consumer.
I think it's really interesting at the moment to see how generational shifts are influencing where investment capital is being allocated. Just give us a sense of what you've observed to that end.
Generally, the people that adopt technology quickest are the younger generation. They're a lot more nimble on a computer. So this generational shift has meant that the younger audience is very switched on to this technology, yet they may not necessarily have the same investment principles and understanding as perhaps their older counterparts. So it's opened up in some ways a bit of a gap, and for those that have been savvy enough to identify these opportunities and back that up with some more, say, traditional investment principles, those are really the ones that are set to capitalise on it the most.
What can next-gen investors learn from experienced investors and vice versa?
The velocity of money in the world has increased rapidly through technology, and with blockchain coming online, instant transactions are now happening daily. So what's happening is that the younger generation can learn not so much the sectors to invest in, but principles around strong management teams, strong business plans, strong financial modelling. Marketing principles still apply, whether it's marketing a traditional department store or marketing say a mobile app. It's all about user acquisition, whether it's people walking in the front door or downloading an app. So the same principles still very much apply. Perhaps one of the areas that we've seen that there's a deficiency in the younger generation is that if they don't adhere to these really tried and tested models and business principles associated with the strength of the organisation, and they go off at a tangent developing something without really being mindful of how they're going to promote it, how they're going to retain customers, and ultimately how they're going to develop and also create value for shareholders. There's definitely a big opportunity for the more traditional investors, which you could say and argue is slightly older generation, to work more closely and listen to their counterparts and vice versa, to make sure that there's that convergence, so that ultimately if someone is making an investment decision, it really takes into account balanced information from both sides.
James, thank you so much for being with us today.
Pleasure. Thanks, Angela.
That was James Mawhinney from IPO Wealth. And now for an update on where self-managed super funds are investing. With me is Marcus Evans, Head of SMSF Customers at CommSec. Marcus, thanks for joining us.
Thanks, Peter. Lovely to be here.
So 30% of all super investments are in self-managed super funds?
That's correct, yes.
Staggering, isn't it?
It is indeed. And, you know, we are still seeing, notwithstanding some of the changes in legislation, some of the changes in investment markets, we're still seeing SMSFs are growing.
Okay, and you guys have a look at where they're actually investing.
Yep.
And one of the themes you've picked up is that they're out there seeking bargains and they're sort of getting away from the ASX 20?
Yeah, so that was something we picked up in the last couple of reports, and that trend has continued. Now, of course, as the markets change, their focus changed a little bit, and the banks are back. So we've heard a lot of commentary about, you know, have we seen the floor in the bank price? And for SMSFs, they're still paying the same dividend. They know these stocks have got a long-term horizon, and they're back in their buying.
So the banks became bargain basement stocks.
They've basically fallen into that category, and along with things like CSL and Cochlear, Aristocrat, things that have been
belted up.
Yeah, well, they've been belted up after being quite expensive.
Yeah. And
now SMSFs are wading back in.
They're seemingly a lot more sophisticated than they used to be, because a lot of self-managed super fund people often ended up in cash.
Yes.
But you also pointed out they're really going into the international space as well.
And that's been an ongoing trend. So we've seen that over time, SMSFs were early movers in ETFs, they were certainly early movers in international, and now we're finding that ETFs are in fact more than 50% of the entire international ETFs, and more than 50% of all of the ETF traded value. And furthermore, we're also seeing that there's actually a lot more trading in international. They're rotating out of things like S&P 500 into NASDAQ and emerging markets.
They are becoming sophisticated. Maybe it's the Switzer report that's helping
Well,
us.
I've got no doubt, Peter.
So what about the hot stocks? There's another thing that once upon a time they missed these kind of boats, but you're noting that they're actually on the hot stock train.
Yes, we were looking for about how could we say something about wax stocks again, and ask the question, are wax stocks waning? In the case of Afterpay, no. In fact, Afterpay is the 8th most traded stock in the period we looked at, and it's knocked off A2 Milk as being one of the mid-cap stars.
Have SMFs got interested in the FANG stocks?
Look, we are seeing the volumes in direct international. I mean, I think we had a 50% growth last year. We are seeing incredibly strong growth in that space as well. So between ETFs and direct international, the message is well and truly out there.
Because it seems to me what they're looking at, SMSFs, is if really good quality or once loved stocks get belted up, like the FANG stocks, like CSL for a time, Aristocrat, they're becoming the real bargain hunters.
Yeah, the standout in that category at the moment in international is Tencent. It's actually been quite interesting. I think you're right. The technology stocks have taken a bit of a battering. And so we actually expected to see more money flowing to things like Chinese financials, but actually it's swinging back into technology.
Yeah, and the interesting thing is that they're actually placing a bet that Donald Trump will eventually have a Chinese deal and the Chinese stock market will come back. That's real trading, isn't it?
Yeah, it is trading, but I mean, I think, you know, that when you look at it, when the 10 biggest holdings in international are very well-known brands. They're Apple, they're Google, they're Berkshire Hathaway. That kind of doesn't change. Yeah. What changes is the trading around the fringes.
Okay, what's not hot? Telstra. What's happening with Telstra? Well,
I think I've been on your show quite a few times, and I've always said Telstra, the SMSFs will not give up on this stock. Yeah. It looks like at least temporarily they have. Yeah,
and well, I guess, and also A2 Milk. Now that was a darling.
Yeah. Yes. It's off. It's actually a net sell there at the moment.
Great stuff. It's always a very interesting insight, Marcus. Thanks for joining us.
Thanks, Peter.
Marcus Evans from CommSec. That's all on Money Talks for this week. I'm Peter Switzer. Good night. And don't forget to go to switzer.com.au to check out what I'm talking about each morning.
This program proudly brought to you by IPO Wealth for the sophisticated investor.